Good morning, everyone. Quick show of hands if you know of a company that had an extension round. Okay, quite a few. What about a flat round? Several more. And what about a down round? Okay. Those are much more rare, but they are happening. So let's start with talking about extension rounds. The latest data from Carter shows that over 40% of all seed stage companies took at least one extension round. Why does such a high portion of seed companies have to resort to extensions instead of raising a Series A? And Dayna, maybe I can start with you because you mainly do seeds.
Sure. Nice to see everyone. So the question is, why do they raise an extension round? I think, getting the amount of capital properly sized to exactly what you're going to need over the next 18 to 24 months is really hard to do, right? So especially if you're just getting started, things may take off faster. Most likely things go like this. I don't know any company where it hasn't been an up and a down and a sideways. And unlike the public markets, for example, in the startup world, we all know you raise a chunk of capital, then hopefully you keep your head down and, from the fundraising markets and you're building for a time. But if that chunk of capital isn't quite right, maybe you wish you had raised $1 million more. Maybe you have something right in sight that you want to achieve. Those are perfect times to raise extension rounds. The valuation probably hasn't changed a lot because you haven't gotten to market or you haven't scaled. Maybe you've scaled to 500K in ARR, but not to $1 million, or that's all kind of negligible in there. And if you just need a little bit more money to cross the next, turn the next corner, that's a perfectly acceptable thing to do.
Okay. Well, I also understand that some seed companies do multiple extension rounds. How many seed extensions should a company do before it becomes a red flag for future investors? Nikhil?
Such a fun way to start the day to think about this. But look, I think the reality is that you're trying to be either a default alive company or a default investable company off of any round of capital that you're raising. And so, if you're raising a seed and you have to raise a little bit more capital to become either profitable and default alive, or growing at a quick enough rate, sort of strong enough metrics to go raise a larger round of funding, a Series A, for example, on a seed. Taking that extra capital is something you just have to do to get to one of those places. So I don't judge companies negatively based on sort of how many rounds of capital they've raised. But I do judge companies based on sort of what they have done on the total amount of capital that they've raised, the judgment they've had along the way. And so what's important for me is like understanding the game film and exactly what has led to those extra rounds of capital. So for example, like maybe you started with a completely different idea, and then you realized it wasn't working and you made a really difficult decision to go focus on something else. And maybe that something else was leveraging a new why now that emerged after you started the business, such as AI and LLMs. And then you needed an extra round of capital, and then you needed a little bit more as you started to see it work to get to a place that's default fundable. I think that's a perfectly acceptable journey, something that I'd be excited to fund at the next round. And so it's really all about that narrative and what actually unfolded and trying to judge that for me versus judging the number of rounds.
Great. But do you have a certain metric or revenue in mind before a company is ready for that Series A? I know that the goalpost may have moved since kind of the 2021 frenzy.
Yeah, I'll jump in on that one. I think I'll blend the two questions. So there's no red flag in my mind pursuant to how many seed extensions that you've raised. I think the early view on the scalable metrics that matter as you're thinking about your Series A that you can hopefully reverse engineer into a Series B, that's actually the potential red flag or the orange or green flag for an investor and hopefully for your executive team. If you're an enterprise SaaS, for example, you might want to see things like CAC payback start to work a little bit, or time to close, or pipeline as a lead metric starting to increase. If you're a PLG motion, something that I know you guys spend a lot of time on as well, you just want to start to see that the product itself is tooled in a way that it's starting to self-convert. In terms of marketing qualified leads coming in, there's so many other kind of underlying metrics that I think matter more than just cash burn or cash runway. And to use Nikhil's language, default investable just means all of those underlying metrics start to tell a story that says, if we put $1 more into the business, X, Y, and Z will come out. And in the early stages, it doesn't have to be, 50 cents will come out or $1.50 will come out. It could be, we have 300 new freemium users, 3% of those that convert to paid, or for every dollar we put in, we have XYZ more leads that are coming through the system, and that time to close is shrinking. So I think oftentimes, we're coming out of a place, we at the firm called it the sassacre, where in 2022 into 23, everything changed, software became much harder, budgets got tighter, and we as investors advised CEOs and their teams to just be default alive only in the term of how much cash do you have and how many months of runway do you have. We've kind of gotten through that really tough period, and now it's just about those underlying metrics that say, okay, if we keep putting that next dollar in, this is what's going to come out.
How are you guiding your companies that are growing at a decent rate, but are still not worth a fraction of their last round?
That's a good question. I'll start. I think everyone in this room probably is relatively early stage. So generally, where you are in terms of your last round valuation is, unless you've gotten an exorbitant early stage just based on how wonderful you are valuation, and that does happen, that's usually not too out of line at the seed to the Series A. But it certainly can happen, and it can happen certainly at the later stages where things get super competitive and you raise more because you can, and there's a lot of investors chasing you, and so why not take 20 instead of $12 million at a higher valuation? Just to put that in perspective, the valuation that you raise at, think about the next round valuation, you want to typically 2x that or 3x that. Obviously, you could raise much more multiples of that if things are going really well. But it does set the bar higher every time. So if you raise a Series B at a $100 million valuation, you should be thinking, to meet people's expectations and not get overly diluted in this company, can I achieve enough in that time period to then raise at $200 million or greater in my next round valuation? Some people, and you should align with your investors on what their expectations are too, and you should pencil it out in the math. So I think, there is a lot of situations, right? There are a lot of situations right now coming out of the ZERP era where valuations are out of line with what the traction is at the company. And I think that's a conversation you have to have first with yourself, your team, your co-founders, and then with your investors, and and then assess what the demand is in the market to actually right-size the valuation of your company. If you want to take a down round, if you want to recap, reorient the cap table along with that, so that you can incentivize the people that are there on your team, on your cap table, for a great return and a great outcome for the future. It can be done. It's hard, it's messy, it's hard to find a lead, candidly. It's hard to find someone to price that down round sometimes. Just human, personalities don't want to be the bearer of bad news and have to go and do those right sizings. So it's just harder. But it can be done, and I think it's often easier to start the conversation if the founder is the one that really wants to make it happen.
So can you talk about a situation in which you helped a founder decide if they should take a down round or if there are alternatives?
I'm happy to speak to one that, just a real-time case study. And so there's a company that we're close to that raised a Series A round. I think it was a $12 or $15 million round at a $60 million post-money 2 years ago. And then they kind of pivoted from being more product-led growth, self-serve, to being more enterprise over the last year, started monetizing, and they've gone from 0 to $1 million of ARR in the last 8 months. But their last round was at a $60 million post-money, and it was a Series A. They kind of now have Series A-like metrics versus more Series B-like metrics. And what the founder is out there saying to investors is, I know I have more Series A-like metrics. I've already raised a Series A. And so I know that this round is sort of between a Series A and a Series B versus being a Series B round. And I'm totally open-minded about valuation. I'm just trying to find the right partner. And that's at the end of the conversation where they're presenting all the things that are going really well in the business and all the positive momentum in the business. And I think that that's an appropriate way to frame a fundraise. I'm curious, actually, for your guys' feedback. Would you counsel this founder to do something different to what I just suggested? Because I think what they're doing is showing open-mindedness about sort of exactly what the price should be. Maybe it's flat to the last round. Yep. But also, projecting confidence in everything that they've accomplished in the business over the last 12 months.
Yeah, I think that's right. For those of us on the stage who've been on this side of the table for a long time, I'm in year 19. I think one thing that's happened the last, I don't know, maybe 7 years is thanks to our friends at places like TechCrunch, we oftentimes over talk about the fundraise itself in terms of the valuation or the size of the round being the win, when it really does go back to fundamentals of your business. That needs to be celebrated more. Obviously, they're private companies that everyone's working with, so you don't disclose everything, but sometimes when I read these funding rounds, particularly in this very interesting AI place that we're living in, where it's a $200 million seed round or a $300 million series, I say, well, what does that even mean? I'm not sure what that means. I wish we would talk more about...
They have a lot of money in the bank.
They do have a lot of money, correct. I wish at times we would pry a little bit harder to celebrating the customer wins. Right. And, I mean, we're probably wonky investors. We don't want to talk about like efficiency scores or cash conversion scores, but talking about some of those underlying metrics. So tying back to what Nikhil was saying, I wouldn't advise them to do something different, because at the end of the day, the term sheet that you've been given doesn't necessarily represent like true value, but it is a good waypoint or a good North Star for the value or obviously valuation of your company. I think the last kind of perspective I have on this is I've certainly advised 3 of my companies in the last 18 months about doing flat rounds or down rounds. And, it's an emotional thing. Like, we're all human. It marks, your business in a way. It has impact psychologically inside of your business. But again, if you pair that valuation, whether it's a flat round or a down round, but you tell people, hey, it might just reflect that public market comps are down 70% since we raised last time. And we're only taking a 30%, down round from our last valuation. That's actually kind of a win, because if we were a public company, we'd be down 70 or 80%, like some of the large public companies that were going after their customer base. So yeah, we're still growing. We might be down 30%, but giving some context can be really helpful as well.
Can you explain why a down round is considered such a bad thing?
Well, I think from a founder's perspective, it's quite stressful, because it means that you've got employees that you probably incentivized with some equity to join, and they think, it's worth something today and it's going to be worth 10 times that. And there's dilution with the down round. And so, those same employees, get diluted, the founders get diluted. It just is a contraction. And, inside those public market companies that Elliott was speaking about, there are those same elements going on, right? They all took, actual options, and they see the value go up or down or sideways every day in those public companies. So I think that the right framework is sort of what Elliott said, is, owning it, saying, the market is different now, but it doesn't, I think the scariest thing for a lot of founders, CEOs, is how to manage morale through that. I would say, having been through things, having been in venture for a long time like Elliott, and going through things like the financial crisis, where it was a much more dire situation in the markets than what we see today, for sure, that people are resilient, employees are resilient, teams are resilient. Teams like to be given information, they like to understand the end game, and you can absolutely still incentivize people through down rounds. You can, reallocate options to the people you really want to keep You can trim staff where, you need to, and people keep their heads up, and they're fairly resilient, and they're very responsive to that information in a very positive way is what I saw through the financial crisis. And it was something that was very reassuring, but very scary for founders to take that first leap into. The first reaction is, if we do this, I'm going to lose all my great people. That's, what they think immediately, and that's very scary because they've had to go out and recruit them and compete with other companies. But if you empower them to be a key member of the team and give them more options and do other things, they might be even more excited to be there.
I also understand that in a down round, a founder winds up with a much smaller stake in the company. Is there a way for the founder to grow that ownership stake back if they come back from the down round and start raising it?
Yeah, I can touch on that. So I serve the board of a company that raised 3 times in 13 months in the 21 kind of craziness period. Enterprise SaaS company, relatively long sales cycle, 6 to 9 months. And then when people stopped buying software and the growth rate slowed, the burn rate increased, we had to make changes internally. And as you said, everyone kind of took a hit when we needed to raise more capital. But what we did at the same time was put not a mixture of things. One was a cash incentive for the entire company that said if we got back to 60% top line growth on this burn multiple, then we had reserved, I think, a couple $1 million in the side that we would pay out in cash bonuses. And then for the founder, CEO, and I think 2 or 3 of the top executives that had been there kind of 3 years, we set 2 ARR hurdles that said, if we hit X amount of ARR in the next 18 months and Y amount of ARR in the next, I think it was like 30 months, we would give more options or accelerated options for those executives. And what that allowed us to do is we made the company-wide goals and the executive goals very transparent. And again, that helps to remind people that, yeah, it's a down round where the valuation has changed, but the core underlying business is still solid. We still have a lot of customers that spend their time and money in our product every month and every year. And if we can rally around just kind of the new normal where we are and outperform, there's ways that we can give equity back to not just the founders, but the entire executive team and people as we go through the org, but as well a little bit of a cash incentive and something to really kind of rally around. I would just add one other point on this. Look, if your company is taking an extension or a down round or some type of alternative financing, there's a pretty good likelihood that someone else in your space or a competitor is dealing with many of the same challenges. And having lived through kind of post-global financial crisis, and then we had a little bit of a startup blip in 2014, if you can maintain enough resources in your company to keep going and refocus and sometimes pivot, as Nikhil was talking to, many of the companies that make it out of those cycles end up being the most iconic big companies. And why? So if you're going through a little bit of a challenge, and it's very likely that your competitors are too, some of them may or may not make it. They might not refocus in the same way that you are, and then your CAC comes down. Retention can go up. Your ability to recruit can go up. So it's just, again, trying to stay in the fight. If you've taken a down round, that's okay. And in a tough market environment, that can actually be a win. You might not see it or feel it until 4 or 6 quarters out, but a lot of the times the market can open up to you if you're willing to stick with it.
Yeah. So a follow-up question to that is, would you consider leading a down round as an outside investor?
Yeah, I'm happy to jump in. Our first investment when we started our firm in 2021 was actually a down round recap of a company that had to have a total pivot during COVID. And actually, it's a company that announced a new fundraise yesterday called Table 22, which Lightspeed just led a Series A into. Their initial business was in the college housing market, which got just decimated the moment the pandemic hit, and when students had to go home from college. And they retrenched and they found an entirely new business, and that business started to work. And then we came in and we just did a total reset where they had raised a big round from Tiger Global. Since I've named the company, I may as well just name the investors. And we just reset the preferences, entirely new round, had an option pool for the team, and the company has managed to sort of survive and thrive from that experience. I actually think, hopefully maybe next year at Disrupt, maybe it's happening this year, you can have a set of founders that have gone through a down round and come out the other side. I think we're going to have some amazing stories in the next few years. Company I'm not involved with, Navan, formerly known as Trip Actions, maybe some of you are investors.
Yeah, sure.
But I think their business got completely decimated during COVID because it's in the business travel space. And I believe it's thriving and thinking about going public now. And so, I think we're going to see a bunch of those phenomenal stories from companies that were resilient enough to survive and thrive.
And also Ramp had a down round, and I think they're back up at their valuation I had prior.
It's phenomenal.
Stripe, obviously a great company.
Yeah.
Still is not back to their 2021 levels, but nobody's doubting them, right?
Right.
Company Elliott and I are involved with, Canva, had a round at a $40 billion valuation right at COVID.
Yeah.
And then their next round was at a $26 billion valuation.
And now it's back up. So
That's a great company.
Very, very positive. So let's talk about AI. Obviously, there's a tale of two cities right now. There's AI and everybody else. Would you say there are a lot of overvaluations happening in AI right now?
I'm not touching that one first.
I was going to say, we don't invest that heavily in AI, which is actually true. We are especially staying away from things in the infrastructure level of AI. I think there are a lot of good teams with very ambitious ideas, and that in itself attracts a lot of venture capital. I think it would be hard to argue there are not overinflated valuations in the market. I'm not going to take that road. So, of course, in any bubble, or any, gold rush type of behavior, there are going to be a lot of overinflated valuations. I think the question is where the value is going to accrue in the long term, where startups can really play. Is it at the application layer? Is it at the infrastructure layer? You could argue there's a lot of big companies spending a lot of money in that space. So what is a startup's advantage? That's harder to find. And valuations will adjust. They naturally will as the markets mature. If you look at the 90s of everyone in this room, I don't know if you remember, before there was Google, there was Yahoo, and there were 15 other search engines. Same thing happened in the mobile era in terms of platforms and such that emerged. The values does accrue to the applications over time, and there's a lot of, shifting around in the early days as people try to figure it out. We can't get it all right.
So if we agree that quite a few AI companies may be overvalued now, does this mean we will see more down rounds, like a year or two from now, for these companies?
They're also raising a lot of money. And so, Elliott talked about earlier from the 2010 to the 2014 era, you saw a lot of companies emerge, or remain strong through that period, or it's because they had a lot of money in the bank and they kept their heads down and they figured it out. So unfortunately, this, part of your job as a founder is timing too, and understanding when you need to raise money. And sometimes the music stops and you need to raise money at very bad times in the market. And if that happens for some of these companies, yes, they'll be reset.
So in about 5 minutes, we're going to start taking questions from the audience. So if you have a question, you can start lining up. So what's your advice to AI companies right now? Should they seek the highest valuation possible, or should they kind of take their learnings from what happened in 2021 and be a little bit more moderate?
So, I think, first of all, I think these AI companies are ultimately going to be valued as companies, which is, based on their growth rate, their profitability. And I think in a couple years, we'll probably not even think of AI as a distinct category. So that's something that It's just that like every technology company is going to be an AI company. So that's something that we try to impress upon companies that we're thinking about investing in as we talk about valuation, and definitely on the companies that we've already invested in. And we have done quite a bit at the AI application layer in the last year and a half. I think the thing that is exciting in the AI application layer is that there's a lot of really exciting fundamentals in a bunch of these businesses. Like we're seeing companies grow at a faster rate than maybe we've ever seen. Like companies go from 2 to 20 million of revenue in a year profitably. And so, and of course, I think some of the OpenAI numbers are public as well. And that is just a remarkable story to go from 0 to $5 billion of subscription revenue, prosumer revenue in 2 years is insane. So I do think that there's companies that have the fundamentals to actually justify the hype and these valuations. But then there's the ones that really scare me are the companies that don't yet have a product, that have raised just a ton of capital. And I think, ultimately those companies are going to be valued as companies.
Yeah, I guess my perspective on this is, if you take a step back and you think about, obviously we're going through just a transformational platform shift in technology. But this interesting thing happened where, we had the crazy run-up of the ZERP era, then kind of a retrenchment in 22, and then in 23, the OpenAI kind of ChatGPT moment happens. And then all the boards of companies that buy software, buy technology, they looked at their CIOs and said, here's $50 million, go buy AI stuff. And now we've kind of lived through 18 to 24 months of buying AI stuff, and where we've seen companies go from 0 to 4 and 4 to 20, or 0 to 8 and 8 to 22. One of the questions now is what's going to be renewed? Because the CIO budget is starting to dry up a little bit, and now it's, okay, we bought 50 things, we tried AI stuff, what GM or P&L owner, like what's actually deployed, what's actually making us more efficient, what's deriving value, not just inside of our enterprise, but ultimately extended to our end customer. So we're starting to see durability in the products of these companies come into question. But if you are a company that went from 0 to 4 and 4 to 20, you probably raised a really high valuation, and perhaps that's okay, but battle testing that company and that product, and were they buying 4 or 5 of the same thing to see what sticks, that's starting to come out in the wash a little bit. And if you did raise, call it $50 or $60 million, hopefully you did it really efficiently. And we've just been advising entrepreneurs to just pause a little bit. Let's see how this Q4 into kind of fiscal January goes to figure out what is actually going to be retained, what's going to be expanded, and then set a course into 25, 26.
So it sounds like you're paying a lot of attention to renewals. The quality of revenue may not be strong as initially thought.
Yeah, I mean, when we talked to CIOs and CISOs 2 years ago, it's like, send us all your AI native companies in your portfolio. And we said, okay, here you go. And now 2 years later, they're saying, okay, don't send us any more. We're going to deal and spend some time with the 40 or 50 we contracted with to see of those 40 or 50, what are the kind of 5 to 10 that we're going to actually deploy and try to change our own workflows. Does that make sense?
Yeah. So does it feel like it's kind of the hype is beginning to slow down a little bit? Are you noticing that, or we're still kind of at the top of it all?
I think Elliott's point is that it's just getting real. What is actually performing. I think there's also the question that we constantly ask ourselves of, if this is the next best thing now, how quickly can others catch up? And I think that question is still out there with AI applications. To your point, they're probably trying to figure out, is this really meaningful, and is there something else we can do to produce the same value? And with the promise of AI, the answer appears to be yes, we should be able to create similar impact in a short amount of time, and where that will end is still an open question.
I think there's 2 things that are kind of complicating the hype under the surface. One is renewals and retention, as Elliott mentioned. And the other is just some of these categories are so competitive.
Oh my God, yeah.
And there's like 20 companies doing something really similar. And if you have bought like 3 of those things, and so I guess this somewhat ties back to the renewals retention point, you're not going to keep all 3. But yeah, it is really difficult to ascertain what's defensible and sort of must-have long-term sticky right now.
I think the last comment, and we've got obviously some great people that want to ask questions. I think what I saw unique to this technology shift, different from some of the past, is typically the PhDs, data scientists, ML engineers inside of the companies usually got like 6 to 12 months to map out a roadmap of how are we going to take this new technology into our business. That didn't happen this time. And now many of the startups, their biggest competitor and naysayer is that person inside of the org who said, hey, you remember I told you 2 years ago that we can't just buy 50 things and see what happens? They've now brought in their own tooling. They're leveraging the open source AI community, and they're saying, hey, let's just take a pause. We've spent a decade inside of our org. We know where the data is. We know how it's housed. We know the security of it all. And I can actually build some of this tooling internally, but also stitch it together where we need 5 of the 50 things that we bought. So I think their voice, where we shifted really far to the right with CIOs, it's now coming back, I think, to some of the senior engineers in terms of how we deploy.
Yeah, that's a big risk. And I just recently learned that there are 43 AI SDR startups. No more. Don't pitch me in an AI SDR startup. I'm not going to write about it. They all seem the same. And so let's go to audience questions. Please go ahead.
Hi, my name is Saeed. I'm a startup lawyer. As is common during downturns, the liquidation preferences usually increase, like, for example, for the past 2 years or so. And it's easy to label VCs as like ultra capitalists or like just, bad partners and so on. But at the same time, I advise my clients as like, look, like it's either not taking any money or just taking this like with the high liquidation preference. And then the flip side of it is I know a lot of VCs are also under pressure from their own LPs for not like having exits and returns and so on. I think I have 2 questions. Like, how do you balance for yourself? Because when you were talking, it sounds like you're all nice partners to your startups, but like at the same time, you have the reality, economic reality, like, and then fiduciary responsibility towards your LPs. Like, how do you balance that for your own startups? And then 2, if you see something unreasonable, like in the cap table from a fellow VC on the table, like that you invest together, and if they push for something unreasonable, how do you either push back or have they advise the startup to push back on that? Like, look, like 3 times is unreasonable, let's go down to 2 and so on.
Yeah, the easiest way to think about this in my mind, I always use the term gingerbread. So oftentimes when a company has some challenges or faces some challenges and needs, let's call it 18 to 24 months of capital to get through a rough patch, investors show up, they do their diligence, they give you a term sheet, and if you really put your glasses on, you see the gingerbread, which is structure, kind of what you talked about. Look, the reality is we advise our founders and our companies to always lean towards the cleaner term sheet. But in reality, sometimes structure forces a lot of discipline. We've seen it where, a lot of structure is offered in a term sheet, and you can kind of tweak the structure that's both good for the investor, but sometimes good for the operator or the operation itself. There are some, I hate to use this term, but vulture capitalists or buzzards circling around some pretty interesting companies, and they're just throwing the whole kitchen sink at companies to see what happens, and that's part of kind of investing as well. There's no silver bullet for this. You try to get 2 or 3 different offers, and if they all have structure, try to come up with something that you think reflects the likelihood or the reality of your business to avoid some of those pitfalls. But it's just kind of where we are. And if you really believe in your business, are willing to do that hard work, taking some structure in this moment can be challenging, but hopefully 12, 18 months, you're talking to a new investor that might unlock some of the structure from the prior round. There's no perfect answer for it, but I think that's a great perspective.
Thank you. Go ahead.
Thank you. Hi, my name is Taran Tan. I represent Passini Yachts as the founder. So we're trying to decarbonize marine by electric platforms. So I'm coming from a hardware climate tech perspective, balancing profit and purpose, right? And this really keeps me up at night amidst having to raise a seed round and Series A in the next year. We now live in a world where we have Gaza in rubble, Iran pissed off, North Korean troops in Ukraine, China in an open trade war with America, even amidst a very hidden internal economic struggles. I mean, think COVID-19 early days, right? AI in this tech conference now openly acknowledges it as overinflated and in a gold rush. Crypto looks probably to take a Santa Claus run, which will elevate risks. The world is waiting on what happens on November 5th to see how it influences capital flows, which leads me to my question. As VCs in today's market, how do you advise your portfolio companies and companies you are looking to invest in on how to navigate the next 12 months?
You listed a lot of challenges in the world right there in your question. And I think in some ways, it's hard to imagine a time in history where there isn't another list also percolating. That's just the way the world works. We had some really great times in the past 10 years where the world was fairly boring, I would say. But there's always something. There's always something specific to your business or specific to the world. And the advice we give is you're building a long-term business, you're building something of value. The ebbs and flows, again, when the music stops, you have to pick your head up and find out what's going on in the world, and that might be a really unfavorable time for whatever it is that you need to do in the capital markets, raising money, et cetera. But if you build your business for the long term and keep your head down and do things like, are my customers buying? Are they renewing? What is their outlook on the world? Am I serving something up that they want to buy? It's really all you can control.
Yeah. But my advice is take that list. You can stack rank it however you want to. But if you're building a startup today, there's a list that matters more, which is, what are my customers worried about? If you can really list that out and understand the nuances of what are they most worried about, what are the challenges that they're facing, and reverse engineer your product or your offering to solve that list, all those other things you can't control. I mean, you're right, we have an election next week. I have no idea what's going to happen. I'm not even sure what's going to happen if either side wins, quite frankly, based on how the last election went. But your customers' problems probably aren't going to change. But if I think you mentioned a little bit about your business, if you think either side of the election, let's just pick one, is going to cause a unique set of challenges for your customers, talk to them about that now. Be thinking about that now, not exactly what it might mean for you personally or employees, but what does that mean for your customers and how do you reverse engineer your company?
It's nice to hear a VC say that.
Yeah,
That's a challenge, right? We have to know that that's how you think as well, right?
Yep.
Right, and it's not just about
For sure.
the business itself, right? There's so many things that we can't control.
For sure.
Thank you. Go ahead.
I know we're short on time, so I'm going to skip straight to my question. And at the risk of asking the dumb question, I am a nascent founder. I appreciate what you just said because I came out of UX research.
Nice.
I'm a nascent founder. Some of what y'all are saying is going over my head, but there's a lot of noise that would teach a founder or teach a founder poorly about funding. I'm learning a lot here, but if you could name one source that is trustworthy amongst all the noise, aside from obviously TechCrunch, what would that source be? Long form, short form, don't care, want to consume it.
Thank you. And that will be that last question. So.
Great. Oof. I mean, I'll tell you, so when I was a nascent founder, and I guess he's become more controversial over the years, but when I was a nascent founder, I found Paul Graham's writing to be just really clear, and I continue to find it to be that way today. Like his recent pieces about how to do great work, I think are some like that piece in particular is some of his best writing, and there's some great messages in there for founders, for employees, for anyone trying to do something great.
There you go.
So, Dayna, can you name one source, and then Elliott?
I would add Fred Wilson to that list. Anyone who's been around for a while and gives and does really objective sort of blogging and sharing. I think Paul Graham's a great example. I would add Fred Wilson to the list.
Yeah. So I don't like digital books. I hate them. I like to feel a book in my hand. Still today, the only digital book on my phone is Venture Deals by Brad Feld. I still have the second edition, which is kind of sad. But I just think that is the most balanced resource of understanding how this industry and business works from both the entrepreneurial side, but also from the venture capital side. So you can put yourself in the shoes of both sides of the table. And it's so valuable in that way. And now, it's online, and the book is taught by venture capitalists. I flew out to Colorado and did like 4 days at his house, and it's free. So you can either watch it, listen to it, or read it. But I think Venture Deals would be what I suggest.
Thank you so much
Good
for
luck.
a great question. And we're out of time. Thank you so much.
Thank you.
Enjoy the rest of the conference.